which to me is actually a really, really big invention. The fact that you cannot make more than 21 million Bitcoin, it just can't exist. The network and the 30,000 nodes and all the miners that are mining it are all set up to defend that. And as a result of that, I believe Bitcoin is effectively becoming a form of digital gold as a result of its adoption. And so I say there are really two kinds of sound money in the world: analog sound money, that's gold, and digital sound money, and that's Bitcoin, or the emerging digital sound money, Bitcoin. And there's some people who would argue it hasn't gone far enough to prove its worth, and admittedly, it's only 14 years old. But if you look at its performance in terms of price appreciation and its Sharpe ratio, which measures risk, in spite of its greatly volatile nature, it's really been a pretty good investment. And I think that's going to continue because the trends that drove it this far, they're not really reversing, right?
Well, we do want to get further into your Bitcoin analysis, but I have to touch on something because you said you don't think that Satoshi is one person and a committee. So I kind of can't let that go, even though I was hoping to chat about Bitcoin more at length later on, but I kind of can't let that go because who is this committee?
If Hal wasn't Satoshi, he knew who he was. And I think Len Sassaman might have been Satoshi, but I actually think they all collectively worked to pull it together. So that's kind of how I see it. And
Larry, you're now going to take me down a rabbit hole that I wasn't
going to go down. We don't want to go there, right?
but I kind of have to then ask, what's to say that some of these players then can't resurface at some point?
Well, Adam Beck is still around doing work on the code. Let's go back to how the whole thing works, okay? It's controlled by the core developers, and it's voted on by all the users and the node holders and the miners. And so the fact of the matter is that it's decentralized in that respect. And, and we've been through some big, fights. There were the hash wars, the block size wars. There were a lot of the spin-offs, where the fork wars, where people created alternative forms. You've got this guy, Craig Wright, who's claiming he's Satoshi and Bitcoin Cash is the real Bitcoin. And so, what came out of all of that is you've now got a core, it's a public source, set of code, so anyone can look at it and see it. And you've got these core developers, all of whom can propose changes, and the changes have to be accepted by a really large majority of the users to be accepted. And therefore, as a result,
I just want to lay the background of your investment thesis at large.
Sure.
And you've long maintained that the math doesn't work, that a system in which debt growth exceeds GDP growth just sows the seeds of its own demise, and that once quantitative easing begins, it just can never be stopped.
Exactly.
So break down the premise
I'll try and
of your
do it.
investment theory.
It's simple math, really. So debt is consumption brought forward. If you borrow some money and buy something that you couldn't afford, you've consumed in front of your ability in front of your production, so to speak, and you've taken on the debt. And it means, in theory, you've got to pay the debt back in the future. And so that's consumption delayed. And so, we've built a society because of Keynes and his whole theory that the government should take on debt in slow times and deficit spend in order to keep, animal spirits going and keep the economy running. And of course, he was addressing the Great Depression, which was, he was misaddressing it, but that's what he was addressing. We built a world where the solution to all economic slowdowns is to take on more debt and bring consumption forward, and then pay it. Allows the GDP number to get bigger relative to the debt number, and so that the debt can be paid back. But this is just a mathematical certainty, and we've now, everyone says, well, what we've got here is we've got can-kicking economics. The government at every stage of this debt cycle has figured out a way to kick the can down the road. And you know what? It's surprising. A lot of people don't think it has happened yet and don't think it will happen. But I think if you look at the signs out there, it is happening. We're at the end of the road. There's, the can's gotten really heavy, and I don't think there's another kick available. And so as a result of that, something's got to happen. And and by the way, we've been here before. This is what I call a sovereign, and others have described as a sovereign debt crisis. And that is to say that the US government and other governments have now, taken on so much debt and inflated the economy so much that they cannot service it. And they either have to let the debt collapse, which would be very much like a depression, or they have to print so much money to service the debt Gresham's law will kick in and people will lose confidence in the ability of the government to maintain purchasing power, and the purchasing power are extremely low. So that's kind of the big picture thesis. Did I do it that accurately in terms of what I'm
accurately enough. Let's focus a little bit more on the short term, though,
Sure.
because Fed Chair Powell, he's been raising rates aggressively, trying to channel his inner Paul Volcker there. Right. The thinking was that he would raise until something breaks.
Right.
It looks like things are on the verge of breaking after the Silicon Valley Bank collapse and Signature Bank. Yeah. So the expectation is for one more rate hike and then a pause, although the Fed future curve is showing rate cuts. What do you expect we'll see from the Fed sort of near term?
It's a great question. I just tweeted out about it. In fact, yesterday they were saying the odds were greater that we were going to do another 25 basis points in May. And today the odds have flipped. It's now 60-40 that they're going to cut or leave it flat in May. Look, I'm absolutely sure based on what I've heard and learned, that Paul Volcker has been talking around, DC, and I'll say, you know what, we think inflation's coming down, it's kind of under control, and we're worried about the economy slowing down. We're going to pause or maybe we're going to cut rates. And that's what the market is saying. Fed funds futures, as you just alluded to earlier, they're pricing in several rate cuts by the end of the year. And I think that's probably what will happen.
Okay, so if we're adjusting to a new inflation normal of, say, 5%, and they declare a victory at inflation at around 4 or 5%, whatever the numbers that they tell us inflation is. And what it really is, that's a whole other conversation. Right. But what does that mean in terms of the economic conditions? Because you presented a chart of year-over-year M2 money supply growth, which has just turned negative. Mm-hmm. And the last time it did so was during the Great Depression. Right. So do you believe we're in for a recession on par with the Great Depression?
That's a great question. I don't know the answer to that. I think there's almost, in my mind, there's zero doubt we're in February and so of 2022. And so here we are a year later. And, there's been an effect. If you're a home builder, you've noticed it. But It takes a while for the whole economy. And by the way, the economy was pretty robust and was kind of cooking along at a pretty good rate with all that free money that they dropped into it. So it takes a little while. Some of it is, it's like, imagine we'd had so much booze and we were so drunk. Right. That, even just because you stop drinking, you still, even the next morning, you might still be a little bit high and hungover. So give
it to me in percentage terms, just while we're on the topic of the S&P 500. How much more of a decline do you anticipate on the S&P 500?
I think another 30% is a no-brainer. Okay. Absolutely no-brainer. Highly likely in the next year we see another 20 or 30% dip in the S&P. And I think there's a possibility before this whole thing is over, the S&P is down 70 or 80%. One of the things that people forget, remember, stock prices are a couple of things. One, there are a multiple of earnings. And so, the multiple of earnings right now is around 20 on the S&P. And that's at the higher end of the range.